Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. I'm trying out a new thing for January 2025 for the new year. If you comment in this or the other two videos that came out in January, I will put you in a draw for a 1-hour one-on-one mentoring video call with me, a $50 value. We can look at your portfolio, talk about financial independence, personal finance, retirement, whatever you'd like. So comment below. Up to 3 entries are allowed, one per January video. I had a question about possible ideas for investments with the new US administration coming soon. I think there's a lot of unknowns as to what Trump policy agenda might be. One can scan the various mediums of social media to try and work out what's really going on, but no one really knows, and I suspect that's elements that Donald Trump doesn't know himself. Let's break it down in some simple measures for an economic perspective and from the perspective of corporate earnings. Donald Trump is probably likely to be quite good on the balance. You have to work out what's priced into the stock markets, however. But I think his growth agenda is there. I think that his willingness to support US companies is also there. In the sort of short to short medium term, there will be a sugar rush for that. And equity markets will have started to reflect that in the last few months for the medium term projections, though. It is more difficult to know, not least because the policies, but also the US is in a situation where there's a lot of debt, there's a lot of situation where the economy looks quite strong, but it's patchy. Nobody knows what's going to happen. Trump says a lot of outrageous things. Some might happen, some will not. But the markets hate uncertainty. Time and time again, the markets seem to prefer a negative, defined result rather than letting the market use its imagination on what could happen. With the new Trump administration in place, there are several investing ideas Canadian investors might consider. The first one would be tariffs. There's an ongoing tariff threat from Donald Trump that could hurt business investments. 10% uniform tariff hike on all US imports and a China tariff increase to 60%. There's a small chance of the 10% uniform tariff, but Trump is much more likely to seriously pursue and implement the China tariffs because of the increasing bipartisanship of the anti-China sentiment. And given the large jump in China tariffs already implemented in his first term, there's more reason to think Trump will follow through on his newest threat on China. I'd expect a 1.4% decrease in the level of US real GDP in the case of the uniform tax hike, and a 0.5% GDP decrease in the case of the China tariff. Higher tariffs unambiguously cause a reduction in the real US GDP and are generally thought to increase inflation and prompt the US Fed to increase interest rates, hurting demand and generally slowing the US economy down and increasing the value of the US dollar. Big Oil is counting on a tariff exemption. Will it get one? Canada is America's top oil supplier. The US buys something like 4.4 million barrels from us daily. So even since Donald Trump started threatening to impose across-the-board tariffs last summer, the general assumption has been that he meant everything except oil. Well, a few weeks ago, Alberta Premier Danielle Smith returned from Mar-a-Lago with a sobering prediction that oil won't get a tariff break. Canadian oil stocks sank by 2.6% on the news, but shares recovered fast and are still way up over the past months. That brief disruption suggested that 1, the prospect of oil tariffs is indeed spooky for markets, but 2, insiders, despite their mini freakout, still suspect that Trump is self-interested enough not to slap a levy on Canadian oil, since doing so would drive up gas prices for Americans. Some auto parts can be transitioned easily to be manufactured in the US instead of Canada with the tariffs, but aerospace, such as landing gear for Boeing aircraft, which is far more specialized, could take 24 to 36 months to get started in manufacturing in the US. I feel it's unlikely there will be tariffs on the large amounts of Canadian oil the US imports, but additional drilling in the US may increase supply and lower the price of oil for everyone. There is no substituting US oil for Canadian oil because of it being a different consistency, medium to heavier crude, and the US refineries not being set up for it. US refineries depend on Canadian oil. Canada and Canadian oil producers will look for a deal to allow US refineries to get the Canadian oil into the US in a way that Americans feel their trade balance is being improved, since that is a key concern. A tariff war will cause Canadian oil to get a lower price per barrel, and for Alberta specifically. For every dollar of lower price cost, the province $600 million in revenue. If Canadian oil suddenly becomes more expensive, supply chains will have to adjust, and with pipelines, that is a long-winded process. The US refineries keep using the same Canadian oil, which now has to sell a little cheaper, but some of the tariffs are passed on to the US consumer at the pump. Canada needs to make a deal to negotiate the tariffs away, whether for a better trade balance or to stop the fentanyl drugs from coming into the US from Canada. With Trump's proposed tariff on imports for Canadians, simply investing in Canadian companies that primarily do business within Canada can be beneficial. These companies might be less affected by trade disruptions compared to those heavily reliant on exports to the US. But what happens if those tariffs aren't as bad as people are expecting right now? Could we see a return to favor from Asian equities, from European equities, or even UK equities? I think possibly. What are the exceptions for this year? It's trying to look through all the noise, all the nonsense, and really trying to work out where there are certain benefits to either liked investments or loathed investments, and trying to take advantage of inefficiencies created by what's going on to be the very noisy 2025. The second thing Canadian investors could do is to diversify internationally. Look for opportunities in markets outside of North America. Investing in companies from countries not targeted by the tariffs could provide a hedge against potential trade tensions. Next, we have the energy sector. Canadian energy companies, especially those involved in oil, mining, and fertilizer, might fare better if they export to countries other than the US. These sectors could benefit from fewer banking regulations and deregulation efforts. Trump declared a national energy emergency intended to provide him with the authority to reduce environmental restrictions on energy infrastructure and projects and ease permitting for new transmission and pipeline infrastructure. Quote, "It allows you to do whatever you've got to do to get ahead of that problem," Trump told reporters while signing the order. Quote, "And we do have that kind of an emergency," end quote. Earlier in the day, he explained the reason for the declaration. Quote, "The inflation crisis was caused by massive overspending and escalating energy prices, and that is why today I will also declare a national energy emergency. We will drill, baby, drill," end quote. He has previously said that surging electricity demand from the technology industry, mainly to fuel artificial intelligence, required a big grid overhaul. Trump issued an order for the US to resume processing export permit applications from new liquefied natural gas projects supplying Asia and Europe, effectively reversing a pause Biden put in place in early 2024 to study the environmental and economic effects of booming exports. U.S. exports of the superchilled fuel set a record in 2023, and the country is the world's largest exporter of the product. But the pause in new export permits created uncertainty for a slew of projects in the works. Plants in Louisiana awaiting approvals include Commonwealth LNG, Venture Global CP2, Cheniere Energy's expansion to the Sabine Pass facility, and Energy Transfer Lake Charles Terminal. In Texas, a second phase of Semper's project, Port Arthur LNG, awaits approval. Turning to offshore wind, Trump suspended a new federal offshore wind leasing pending an environmental and economic review, saying windmills are ugly, expensive, and harm wildlife. Quote, "We're not going to do the wind thing," he said. White House press release and Trump issued an executive action suspending offshore wind leasing from all areas of the U.S. Outer continental shelf, pending an environmental and economic review. The order is not expected to impact existing U.S. offshore wind projects being advanced by companies including Ørsted, Avangrid, Copenhagen Infrastructure Partners, and Dominion. Biden saw wind power as the vital part of his strategy to decarbonize the power sector. Then looking at EV targets, Trump took aim at electric vehicles, revoking a 2021 executive order signed by Biden that sought to ensure half of all new vehicles sold in the U.S. by 2030 were electric. Biden's 50% target, which was not legally binding, had won the support of U.S. and foreign automakers. Trump said in an executive order he was halting distribution of unspent government funds for vehicle charging stations from a $5 billion fund, called for ending a waiver of states to adopt zero-emission vehicle rules by 2035, and said his administration would consider ending EV tax credits. I wonder how Trump's buddy Elon feels about this. And finally, drill baby drill. Trump signed an executive order repealing Biden's effort to block oil drilling in the Arctic and along large areas of the U.S. coast, according to the White House. Trump also repealed a 2023 memo that barred oil drilling in some 16 million acres in the Arctic, the White House announced. It's unclear if the moves would be sufficient to attract big drillers who have shied away from the region in recent years due to relatively high cost of development. Biden last month banned new offshore oil and gas development along with U.S. coastlines ahead of Trump taking office. Refilling the stockpile. Trump said he intends to fill the strategic reserve right to the top. That's likely a reference to the U.S. Strategic Petroleum Reserve, the nation's stockpile of crude oil designed as a buffer against supply shocks. After the invasion of Ukraine, Biden had sold more than 180 million barrels of crude oil from the reserve, a record amount. The sales helped keep gasoline prices in check, but sank the reserve to the lowest level in 40 years. Quote, "We will bring prices down, fill our strategic reserves up again, right to the top, and export American energy all over the world," end quote, Trump said. He will likely look to Republican lawmakers to give him the money for the oil purchases in the coming weeks. Trump has vowed to increase U.S. oil and gas production, fill up the strategic oil reserves, as I mentioned, and export American energy all over the world. U.S. oil prices have responded accordingly. U.S. crude futures have fallen nearly 5% in the last 3 trading days, while Brent crude shed about half as much for the same period. This is what happens when you increase supply. United States is already the world's largest producer of crude oil, accounting for around 12% of the total supply. It is also a major exporter with some 4 million barrels a day, but it faces competition. The OPEC plus group of major exporters, which includes Russia, wants to remove self-imposed supply cuts, but is concerned about slack global demand. Meanwhile, Trump's plans to impose a 25% tariff on Canadian imports could hurt U.S. refineries, who rely on their neighbor for about 20% of their barrels. Next, looking at the banking sector, with Trump's push for fewer banking regulations, Canadian banks like Toronto Dominion could benefit from a more favorable regulatory environment. Investors are also bullish on the incoming Trump administration's impact on the sector because they expect lower taxes and less regulations, which could encourage more mergers and acquisition, a boon for investment banking. Next, turning to cryptocurrencies. Trump's administration is expected to take a lighter regulatory approach to crypto. This could present opportunities, but investors should exercise caution and ensure they're using reliable exchanges. Notably, cryptocurrencies, which soared as Trump's November 5th election win raised hopes of more regulatory-friendly environment, suffered a setback as his first set of policies made no reference to the asset class. On Tuesday, Bitcoin, world's largest crypto, was up 3% to 106,000 and change, well off the record 109,000 touched hours before the inauguration on Monday. Trump launched a cryptocurrency of his own on Friday, which surged from less than $10 on Saturday morning to as high as 74 before giving up some of the gains on Monday to trade at 39, according to crypto price tracker CoinGecko. Trump's inaugural speech disappointed those who had hoped he would kickstart a sea change in U.S. policies towards crypto, which could pave the way for more selling, analysts said. Others said some of his staffing picks were a positive sign. Trump has tapped two crypto-friendly figures, Mark Rieda, a Republican member of U.S. Securities and Exchange Commission, to be acting chair of the agency, and former SEC Commissioner Paul Atkins to run the agency on a permanent basis. Next, turning to currency. So calling out Canada and Mexico as potential targets for tariffs took further toll on their currencies, which fell sharply following Trump's inauguration speech. Bets on the Mexican peso or other tariff-exposed emerging market currencies were too risky, said Fidelity International multi-asset manager Becky Quinn. It is so binary and so dependent on a dollar, she said. The policy uncertainty is too high. Goldman Sachs strategists said they see a 70% probability of Trump hitting China with 20% tariffs, but said the odds of him fulfilling his pledge for 25% import levies on Canada and Mexico were low. The dollar is trading near its strongest levels against the Canadian dollar in almost 5 years, with the so-called loonie also weighed down by economic weakness and rate cut expectations. Markets have swung towards bets that China will not permit its tightly controlled currency to weaken to counter heavy U.S. tariffs. Analysts still expect a 5 to 6% drop by year-end in China's currency. Fidelity Squint said she had a position on that would profit if the offshore yuan weakens further against the dollar, which may be one of the few trades that shines if aggressive tariffs spook markets. Next, turning to healthcare. It is expected that Robert F. Kennedy's going to be negative for healthcare because of the cost cutting and lower spending on healthcare, including Medicare. Now let's look at China. Trump's tariff threats against China could just be a negotiation strategy. A China-US trade deal could trigger a powerful rebound in Chinese stocks. Donald Trump's tough talk on tariffs has made waves, but when it comes to action, his follow-through seems more restrained than his fiery rhetoric. Despite concerns that his hardline stance on China could disrupt global trade, Trump has yet to deliver on the sweeping tariff increases he once touted. While he recently floated the idea of a 10% tariff on Chinese goods starting in February, this proposal is far less aggressive than the 60% tariff threats that he punctuated his campaign speeches. The measured approach suggests Trump understands the potential consequences for the U.S. economy and stock market, particularly the S&P 500 companies pulled in over $100 billion in revenues from China in 2024. For investors investigating the uncertain terrain of U.S.-China trade relations, positioning your portfolio strategically is critical. So Trump's threats against China, are they just a negotiating tactic? Trump's threats of tariffs against China could ultimately serve above all as a starting point for negotiating a trade deal. This is all the more true given recent signs of President Trump's willingness to engage in dialogue with President Xi. In particular, Trump invited Xi to his inauguration. As state visits require months of preparation, Xi did not attend, but was represented by Vice President Hang Zheng. In addition, following the failure of the first attempt by the House of Representatives to pass a budget, the second version incorporated modifications requested by Trump and Elon Musk to remove provisions strengthening restrictions on investment in China. Finally, President Trump has asked that the Supreme Court's decision on TikTok be postponed and has also filed an amicus brief with the court in defense of ByteDance. It should be noted, however, that this issue extends beyond China due to the involvement of donors and the participation of numerous American investors in the ByteDance parent company. While Chinese equities have been battered in recent months due to fears over U.S. tariffs, a China-U.S. trade deal seems possible with Trump back in power, and this would undoubtedly trigger a massive rebound. This is all the more true given that investors worldwide appear to be largely underexposed to non-U.S. equities, particularly Chinese equities. Apart from a potential trade agreement with the US, the Chinese government has begun to gradually stimulate its economy, which could also give a boost to Chinese equities. What's more, China's risk-free rate is at an all-time low while dividend yields are rising, making equities more attractive than bonds, the opposite of what's happening on US markets. So what are the best Chinese stocks to take advantage of a possible rebound? Against this backdrop, the question arises as to which Chinese stocks are the best to buy to profit from a potential rebound and the change in administration in the US. We looked at several Chinese companies whose shares are traded in the US: Alibaba, Baidu, Tencent, Yum Brands, and JD.com. Each of the 5 stocks studied show solid upside potential, according to both analysts, and in particular, Alibaba, JD.com, and Baidu have a bullish potential over 50%. What's more, the health scores of all the companies on this list are also very solid. In conclusion, several Chinese companies listed on the US therefore appear to be highly undervalued at present, while at the same time displaying solid financial profiles, which in itself already justifies interest in buying them. However, if we add this to the possibility that Trump's threatened tariffs could lead to a trade agreement rather than a trade war, it suggests that Chinese equities could be among the best opportunities of 2025. Let me know in the comments if you see something else Canadian investors should be aware of related to the new U.S. administration, and to enter the draw for one of the one-on-one hour mentoring for January. If you have requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.